Hello, class. We're now going to go through lecture 26. 26 starts the third and the final major point of this class. So we first went through reviewing and corporate governance. So we did a brief intro of the course, discussed time value of money, corporate governance. We then started our first big topic, which was estimating the cost of capital. And to estimate the cost of capital, we needed to spend a lot of time estimating the different pieces of the risk-free rate, the equity risk premium, and the beta, and then debt and the weights. We then spent the last month talking about investments. So how to think about cash flows of an investment, and then how to take this information and actually think about firm valuation. The third test is going to cover lectures 26 through 35. We're first going to discuss financing. How do we choose the right amount of debt and the right amount of equity once we decide that we actually do want to take an investment? And the final step is going to be spend a little bit of time discussing dividends. How do we actually decide when to offer dividends and how much? Now, this topic overall is called capital structure. I don't think that's the most obvious term. So essentially what it means is that we want to think about what is the structure of capital, right? Is it debt or is it equity? And usually it's going to be some combination of both. What we're going to start off talking about today is just the trade-off between these two. We'll spend a lot of time the next couple weeks trying to estimate numerically what is the optimal debt level. Today we're just going to talk about more qualitatively what is the difference between these two. What types of theories would give you debt versus equity? And so to begin, we need to understand what debt is, what equity is, and also hybrid securities. So we've talked already about debt. We've talked already about equity as well when we've talked about the cost of capital. So when we're thinking about debt, debt is a fixed claim, right? Debt holders get a certain amount of money. Debt is tax deductible. Debt has a high priority in financial trouble, meaning that if the firm is going bankrupt, they're paid first. It's a fixed maturity, right? You know when you're going to get paid. And it has no control, right? You're not an owner. Equity is kind of the opposite. It's a residual claim. You are an owner, so you get everything left over. It's not the tax deductible. You have a lower priority in the case of bankruptcy. It's infinite, meaning that you are kind of paid dividends for as long as you own a share, and you have some type of management control. There's also going to be things that are kind of hybrid securities. We won't spend much time on this, but there are some types of securities that are a little bit of both. They have characteristics of debt and characteristics of equity. For the most part, we're going to think about firms as either being debt or being equity, and we need to figure out, why would a firm want debt? Why would a firm want equity? Now, before we get there, I want to think about the life cycle of the firm. What do firms generally do as they grow? So we're first going to think about the startup phase. Right? So this is stage one of any given company. Their external needs are quite high, right? They actually need a lot of money to start the company, but they're actually constrained usually during this period. Most of their financing is going to be a combination of owner's equity and bank debt, which means that the owner is going to own their own shares in the company, right, as the owner, and then they're going to take out debt, but it's generally going to be through loans from a bank. Eventually, you're actually going to move over to stage two, which is rapid expansion. The firm is going to grow, and here you're actually going to get into what we think of as venture capital. So you're going to try to find equity holders. And the first way to find equity holders is generally through venture capital, right? You're going to find people who specialize in kind of investing and buying shares of small, high-growth firms. Eventually, these firms are actually going to instead move over to stock, common stock. And this happens after you go through an IPO. So once you offer an initial public offering, meaning you publicly make shares available, you're going to have common shares available to sell. Eventually, you're going to kind of enter stage three, which is kind of the high growth period after you offer an IPO. We're going to see common stock as being quite common, and we're also going to see an increase in kind of more complicated securities like warrants and convertibles. Right? This is the period where actually we don't need much internal financing relative to funding needs. And eventually we're actually going to hit the mature growth period. When this happens, we're actually a firm that's actually about to decline, right? We're going to be declining as a percent of our firm value. And the reason is because, eventually we're going to kind of no longer be relevant, right? Our technologies, the things we've developed, are no longer that valuable. If you look at these companies, they're primarily going to be financed with debt rather than equity. And when you enter stage 5, you're actually going to see that you're retiring debt and you're repurchasing stock, which essentially says that during this period, right, you don't actually need much capital. We've stopped reinvesting in the company, right? We're kind of on the decline. And so in this period, we actually don't need a whole lot of financing. So let's think about debt specifically for the different companies that we've been looking at. So starting with Disney, the first thing we can think about is what is the value of debt? And as we've talked about before, debt is going to be a little bit difficult to identify and to define. But we can think about book value of debt, market value of debt, and then also lease debt. Because technically leases can be kind of considered a debt, right? If you sign a lease, what you're doing is you're signing a contract saying you're paying a certain amount for a certain period of time. So in a way, that's kind of a type of debt. We could also think about types of debt, as in whether it's coming from a bank or it's actually coming from bonds and notes, right? So this would be in the form of a loan, and this would be more like a corporate bond. Another thing that we're going to be interested in when we think about debt is maturity. How long is the debt going to last, right? So when people talk about maturity, they're thinking about short-term debt, so something along the lines of less than a year, right? 1 to 5 years would be kind of a medium term, or you think about even kind of long-term debt, which is going to be 10 to 20 or even more than 20 years. It's also important when you think about debt, which currency you're thinking about. Are you thinking about domestic currencies or foreign currencies? And finally, the last thing I want to define is fixed versus floating. Fixed rate debt means that the interest rate stays the same, no matter what's happening. Floating rate debt actually floats according to what's going on in the economy, usually relative to the LIBOR rate. The LIBOR rate kind of tells you what is the general interest rate in the economy. And as you can see, most companies are going to be more likely fixed rate relative to floating. So what are the advantages and disadvantages of debt? There's going to be 2 primary advantages, and the biggest one of all is going to be the tax benefit. The main reason why companies have debt is due to the tax benefit. Interest expenses are tax deductible, right? But cash flows to equity are not. So if you have especially a high marginal tax rate, you're going to really appreciate debt. A second benefit is going to be added discipline, and this is a little more theoretical. But essentially the argument is that borrowing money forces managers to think about investment decisions a little more carefully. And the idea here is that if you take on debt, you are required to pay a certain amount at a certain time, right? That kind of enforces you to make those debt payments. And so that adds discipline to managers. No matter what they do, they still have to make those debt payments. So it forces them to really kind of pay attention and stick to a plan. Now, what is the implication here? The implication is that as the separation between managers and stockholders increases, the benefits to using debt will go up. What this means is that as managers and stockholders don't always see eye to eye, right? Managers kind of want to look out for themselves, stockholders want to look out for themselves, but they can't because the managers are in charge. If you have a lot of debt, the managers are forced to do kind of what's in the best interest of the stockholders. So what are the disadvantages? Why wouldn't you just always be 100% debt, right? We have a tax benefit, we have added discipline, maybe debt's all we want. There's really 3 disadvantages. The primary one is going to be expected bankruptcy costs. As you increase debt, you're more likely to go bankrupt. And bankruptcy is actually quite expensive. It's expensive, first of all, because of the direct costs, as we'll talk about later, right? You have to go through court, there's going to be expenses there, right? But there's actually a much higher indirect cost. You're going to lose clients, you're going to lose customers, right? You're going to get bad press, you're not going to be able to borrow in the future, right? These are actually going to be quite high. Now, what types of firms are going to be affected? Well, firms that have really volatile earnings are probably going to be very likely to eventually get caught in bankruptcy, right? Because if your earnings kind of move a lot depending on what's going on, then at some point you're going to have a really bad shock and you're going to enter bankruptcy. So what that means, another way of saying, is that firms with more stable earnings will borrow more. Okay, firms with more volatile earnings will borrow less. Right? Secondly, costs differ across firms in terms of their bankruptcy cost. So firms with lower bankruptcy cost would borrow more. The second issue is agency costs. Actions that benefit equity investors may hurt lenders. We've already talked about this, that if you, when we've talked about kind of protecting lenders, this was back in like the first, second week of class. In this instance, what's going to happen then is that firms where lenders can monitor or control how their money is being used should be able to borrow more than firms where this is difficult to do, right? So if the lender actually has strong protections, then the firm should be able to borrow more. If there's no protections really in place, right, lenders are not going to want to lend, and so you'll find a lower debt ratio. The third is loss of flexibility. Debt is actually kind of adds discipline, like we said, right? That was actually an advantage. But it also means that if something's going on, right, you don't have that flexibility to change things around, right? So it's kind of both added discipline, which is a good thing, but also a loss of flexibility, which could be a bad thing. So when firms are trying to decide whether to invest, whether to pay it for investment with debt or with equity, they have these kind of ideas in mind. Do you want the tax benefit and the added discipline? Or do you want to minimize the bankruptcy cost, agency cost, and the loss of flexibility? So we can kind of think through this just qualitatively for each of the different companies we've thought of. First, the tax benefit. Tax benefits are going to be larger in places that have large taxes, right? So the marginal tax rate in the US is, right, would be 40%, right? This is going to be greater than, let's say in India or China or Brazil. The second is added discipline, right? In places where there's a clear separation of ownership and management, then you really appreciate this discipline. And the idea is because if stockholders don't have a whole lot of say in what's going on with management, right, that's where you can really control management through this discipline channel. The third is expected bankruptcy costs, right? And like we said, places that have very volatile earnings, right? So places that are, companies that are very cyclical, right? Which would be like, especially Vale, which is very dependent on commodity prices, right? Baidu, which would be kind of a young firm that's dependent on technology, right? Those are going to have higher bankruptcy costs because they're more likely to go through bankruptcy. Disney's less likely to go through bankruptcy because they're well diversified and they're just kind of a large company. Agency costs are going to be largest at Baidu. And the reason is really because assets are intangible. What I mean by that is most of the value of Baidu is going to be like on the computer side, right? It's no, and a lot of it's mostly tied up in like human capital, which just means like what the employees know, right? Like code and that kind of thing. And so because of that, it's actually really tough to put those assets up for collateral. And if you can't put things up for collateral, it's actually more difficult to protect your lenders, right? Because collateral essentially protects lenders. If in the case of bankruptcy, even if you can't pay your lenders off, right, you can get compensated, or they can compensate, they can get compensated from that collateral. And the first is flexibility, right? So if you're a company that really needs flexibility because you don't know what's going to happen, such as again Baidu, right? It's more of a unpredictable business. They're going to appreciate this flexibility. So in each of these settings, we can kind of think through each of the different companies, right? Which ones are going to have the greatest tax benefits and added discipline benefits? Which ones are going to expect the greatest bankruptcy cost, agency costs, and costs due to limited flexibility? Now, this is kind of the major point and kind of the real start of this literature. Imagine there's a world that you live in where none of these costs and none of these benefits exist, right? So first, there are no taxes. Second, managers have stockholders' interests at heart, right? So and therefore you don't need this added discipline. Third, there's no such thing as bankruptcy. Firms just don't go bankrupt. Fourth, equity investors are honest with lenders, so there's no need to protect lenders, right? They're always protected. And therefore, there's no agency cost between those two groups. And fifth, there's no need for financial flexibility because firms know their future financing with certainty, right? So in this perfect world, you have no benefits of debt, you have no benefits of cost, right? What happens to your debt equity ratio? Do you choose debt? Do you choose equity? The argument by Miller-Magliani, which is kind of one of the main theorems in all of corporate finance, is that in this environment where there's no benefits and there's no costs, then it doesn't matter, You can finance any given investment with debt, you can finance with equity, you can do some proportion. No matter what you choose, it's irrelevant. Now, what I mean by irrelevant is that the firm's value will not depend on your debt to equity ratio. It's only going to depend on the cash flows. So the cost of capital of the firm is not going to change if you choose all debt, if you choose some all equity, or if you choose some mix. So as a firm increases its leverage, the cost of equity will increase, right? But it's just going to offset any gains to the leverage. So as you think about this, I want to make sure that everyone kind of realizes, right, that when you increase leverage, we saw the cost of equity is going to increase because the beta increases. Right? We saw this with unlevered betas. But the point is that you're putting more weight on equity, which is usually more expensive, right? But you're also now have less equity and more debt, which is generally cheaper. And those things are going to exactly offset each other in this perfect world. So no matter what you choose, right, your cost of capital is going to be the exact same. So let's think through two different questions. First, in a world with no taxes, default risk, or agency cost, Miller and Magliano are going to argue that your debt ratio is irrelevant. That's what we just saw. And that your firm value will remain unchanged as the debt ratio changes. Now we're going to add one complication. We're going to assume that you can introduce tax benefits for debt and that you insure firms against default. What would you expect for the right mix of debt and equity for a firm which is fully protected against bankruptcy, right? So there's no disadvantages of debt. There's only the advantage, which is the tax benefit. If the only thing you change is that there's a benefit of debt, every firm is just going to be all debt now, right? Does that make sense for everyone? If they have one change, and the one change is going to be that there's an advantage to debt, then everyone's just going to be all debt. So question 2, agency costs can arise at any time there's a conflict between stockholder interests and lender interests. Assuming that agency costs are high at a company relative to the rest of the market, which of the following would you expect to observe with the company's borrowing? Right? So in a company where lenders are not protected, right, what's going to happen? What I'm going to argue is all of the above. First, it's going to be able to borrow less than other companies, right? Because borrowers are not protected, it's going to be tough to find borrowers who are willing to borrow to lend in the first place. Okay? You're not going to be able to find lenders, and so you're going to have a lower debt ratio. Secondly, you'll have a higher interest rate than similar firms because, again, those lenders are not protected, right? If they're not protected, they're going to demand higher compensation in the form of interest rates. Third, they're going to force more covenants. Those covenants are going to try to protect them in different ways. A covenant essentially is a contract that allows the lender to make certain requirements, right? Say that if something happens to the firm, right, the firm becomes riskier, the firm's earnings drop below a certain point, right, the firm takes on more debt. In any of these kind of situations where the lender is going to be affected, that there's some repercussions. Maybe they're paid back earlier, right? Maybe they have a higher interest rate, something, so some contract term. So these are the kind of things that would happen, right, when you face these high agency costs. So as I mentioned, right, for the first question, the answer is C. The firm should be all debt funded because there's only tax benefits. Question 2, the answer was D, all of the above. Right? When you have large agency costs, you're going to find a lower debt ratio, so it's going to be tough to find lenders. The ones that you do find are going to charge higher interest rates, and they're also going to put more protections in place in the form of covenants. This concludes lecture 26.